Hey, everybody. Today is a wonderful day. Welcome to the Energy Newsbeat podcast, and we're here recording it. And I'll tell you, Enverus is always a great company. And if you want data and you got to make a decision, go to Enverus. And I'm here with Dane Gregoris. I'm sure I butchered that name up, but I'll tell you what, we are ready for a talk. You're up in Calgary, aren't you?
That's right. Yeah. Based in Calgary, Alberta, Canada.
And you're a managing director up there, correct?
That's right. Yeah. Of the research group. And
we were just kind of talking about how you got to Enverus a little while ago, and you were at the company formerly known as Encana, and kind of like the artist formerly known as Prince. Tell us a little bit about your background and how you got to Enverus.
Yeah, absolutely. Yeah. I guess I got sucked into the energy industry from Eastern Canada. I went to school out there, did an engineering degree, and you know, as they say, kind of moved west pretty quickly after I graduated. And got a job at, as you mentioned, in Canada at the time. I was working in Central Alberta on some really kind of old coal bed methane fields, but sort of cut my teeth on production engineering, which was awesome. And shortly after that, I wanted to really understand the industry from a higher level, think about, why companies make decisions, what drives financial markets. And so I moved over to a job with a company called ITG at the time. And it was the Calgary office of ITG, which was a energy kind of only equity research desk based in Calgary here. And so I've really been in the same job since that time. The company's sort of changed its names a bunch of times, but started as a research associate and worked with a lot of the same folks that I started with today. But the company certainly changed its names. We were carved out of ITG and that was, I guess, 2016 as to be our standalone business, RS Energy Group. And then RS Energy Group was acquired in 2020, I believe, by Enverus. So
wow.
It's been a great ride, and always fascinating to follow the industry through the last almost decade.
Well, I'll tell you what, Dane, those that survive that many transitions of people being bought by a company says a lot for you.
Well, I think we're lucky we're in the people business, being in sort of a research business and a data and analytics company now. Certainly a little bit asset light versus the ENP sectors that we follow.
Oh, all right. Let's go over just a little bit. You just put out a report as a managing director. Tell us a little bit about the report that you just put out. It was Energy Market Insights 2022 themes. Tell us a little bit about your thought process and your team working on this.
Yeah, absolutely. So this is a piece, sort of a culmination of a ton of work that we've done over the past year to give you a sense of the scale of the research or intelligence team at Enverus today. It's about 100 people, and so it's a massive organization from a research perspective. If you look at like relative size of other different kind of industry research groups out there, so we're able to take all the data that is available to our clients and compare that with what we're seeing in financial markets and commodity markets, and then come up with opinions on how we think the next year is really going to play out. And so this 2022 themes that we're sort of anticipating are going to drive energy markets is what the research report is on.
And when we sit here and we take a look at valuations have reset, one of your quotes in here was valuations have reset across the new energy subsectors, particularly in the EV charging and energy storage. Can you allude to a little bit more on the EV side in the storage?
Yeah, sure. So what we've seen, with a lot of the discussion about high inflation through sort of the back half of 2021 and subsequent conversations with the Federal Reserve and other global central banks talking about the necessity to raise rates. It's really pushed a lot of the valuations for what we'd probably refer to as kind of like new energy companies that were recently public, have a super high growth profiles driven by, the necessity to reduce carbon emissions and ultimately, get to net zero at some point in the future. So
Right.
if you think about the preference for the equity markets to like companies that have, super high growth profiles versus companies that are maybe relatively flat, but earning a lot of cash, which would be more of kind of the old energy economy, is it really preferred in sort of the back half of 21 and then specifically in 22. There's been a strong preference for the cash flowing, oil and gas companies rather than these really kind of new energy but high growth companies. So the valuations have reset on the growth side for sure, and that's trickled down into these like energy transition equities. And we think that presents good opportunities. At some point, if there's a lot of companies out there, a lot of capital that has been raised or will probably continue to be raised. So it's going to be super fascinating to watch. I don't think it's clear to anybody who are going to be the huge winners or huge losers, but certainly the size of the prize is big. And so, entering or looking at the sector now may be really fruitful, just given the downdraft in valuations that we've seen across those, energy transition type equities.
When you sit back and take a look at energy, energy's needed in everything. I mean, you're talking energy to heat your house, which is kind of cold up in Calgary. It's kind of cold here in Texas as well as Oklahoma. But how come some of the prices are going through the roof when we sit there and think about the prices of natural gas in New England is just going nutty, and the price is only $5, but they're up in around the $180 equivalent up in New England. I mean, isn't that kind of weird?
Totally. Yeah. I think, this year has been, that's a good way to put it. I think maybe a weird year for commodity prices. A lot of things driving that, in the winter, particularly when it's a little bit colder than expected. If we step back to December, there was a lot of forecasts saying, it was going to be a super mild winter. So I think expectations kind of coming into January were pretty low from a any sort of, expecting any sort of big cold snaps. And so when you do get a cold snap, which the last couple of weeks has been pretty cold in the Northeast, which is the biggest sort of demand center for natural gas, you get weird pricing for sure. And it's if you look back in history and you can sort of see it on the cold winters, especially in New England or other parts of the Northeast, you just get these really, really big prices. And essentially is because there's a ton of demand as people are, need to heat their homes. And it's you either need to get it through LNG, I think in some cases, or different pipeline routes that just aren't really there. And so they need to pull on storage and other supply sources to get it.
Oh yeah, the outside supply sources for LNG up in New England is kind of funny. They're coming in from Russia and Norway, and so we're paying for those. And I would rather buy everything from Canada, and because Canada's got some fantastic regulations up there as far as ESG. So,
well, I don't even think they need it. They need it from Canada. I mean, they have the Marcellus right there.
So, yeah.
So there's not even really. Yeah, they wouldn't even need to go across the border to. But it's difficult to build pipelines anywhere, really. I mean, we just heard, I think it was last week, about the Mountain Valley Pipeline being sort of stopped again by courts. So it's a very sort of structural theme, and it's something that we've been talking about Appalachian gas. Beyond MVP, just given how much of a headache this pipeline has been, and subsequent pipelines before then. Or I guess precedent pipelines before then, it's unlikely to really see another natural gas pipeline being built out of the Northeast. And a lot of people are saying ever, which is kind of hard to think about. But it's just that difficult to add infrastructure.
Don't you think it'd be it's a bit of a hypocrisy for folks to saying we want ESG, but yet they're importing from Russia oil, and Russia natural gas and LNG? I mean, it just seems kind of odd to me, but
yeah, it's a global market. So, I mean, you can, if you're willing to pay certain prices for things, I mean, you can get them. And so I do think there's, like an intuitive kind of strangeness about it. But at the same time, that if you need gas or you need oil or you need any sort of commodity, you can just go out there and bid sort of a high price and get it in short order.
With OPEC Plus meeting this week, what are your thoughts on Libya and OPEC Plus?
Yeah, we think, they've done really since the bottom of COVID, right? So if you think about in sort of 2020, maybe like June, I think was the big announcement where they were going to cut 10 million barrels a day out of the market as sort of the economy was grinded to a halt, and oil demand, cratered at least, call it 5-10 million barrels a day sort of instantaneously. They've really, ever since that point, they've really done a fantastic job sort of managing the oil market, right? Mm-hmm. Taking supply off, adding a bit of supply only as prices really started to, and demand really started to recover. And so we think they are acting in their own interests in terms of driving higher prices. I mean, certainly they could have been more, I guess, or less accommodative from a price standpoint, and just added a bunch of supply sort of whenever they wanted, but they've been pretty thoughtful.
Right.
And so, it's led to, that their policy decisions, and among other different factors on the supply side has obviously led to very strong pricing for oil globally today. We're sitting here, I think it ticked over $90 for the first time since 2014, just
Isn't
this
that
afternoon,
wild?
which is pretty wild.
That is just crazy. This sounds kind of odd, but my team has put together numbers for, various reasons for $120 oil this year. And I'm showing 90.18, and there's some serious problems that does bring in. And nat gas is looking at $4.92 right now. So that and Brent was actually less than it's 89.39. Is it? Unless I'm reading that wrong. I am old, and that's quite possible. So
yeah, I'm not sure. Yeah, that is a bit strange. Usually Brent's a little higher than TI. So
and so when we sit back and take a look, Enverus has got great data. You've got great reach on your foresight and everything else. What do you see natural gas coming around for the US and for Europe? I mean, because that's nuts. I mean, over there, what are your thoughts on worldwide pricing or pricing for natural gas?
Yeah, for sure. I think when the team looks at, we have an entire team that looks at the commodity market on a daily basis, and are sort of refreshing all the data we're ingesting and changing models to better reflect what we think sort of the best guess the future will be.
Right.
And really for both commodities, both oil and gas, we do think that you're going to see some softening. Like prices are really high, unsustainably high. We would
Europe,
argue.
In Europe,
both this would
US.
be oil, globally oil, and then US natural gas prices. I can't really comment on European pricing.
Okay.
Don't have a strong view one way or the other today. But certainly we expect, European pricing is going to be much higher than US pricing, which will incentivize LNG. And that's sort of been a really critical kind of fixture to the US, natural gas prices and US natural gas market. And so we still see that there's a ton of opportunity for more LNG to get built out. Yep. However, in the next couple of years, you have also a lot of supply getting added to the market. So the Haynesville, there's about 50 rigs running in the Haynesville today. there are certain operators, one private one in particular that I think is running, last I checked, 13 or 14 rigs.
Wow.
And then so if you take that plus Southwestern plus Chesapeake, that's like 60 to 70% of the rigs running in the play today. So the Haynesville is an interesting story, because if you take out maybe a few of those private operators and keep production flat, all of a sudden, North American gas pricing looks rather interesting, and it, could stay relatively high. But if you have the Haynesville adding, 2 BCF a day a year for the next couple of years,
Right.
The gas market doesn't necessarily look as short as it does today from an inventory perspective. So you start to sort of add to the supply.
Yep.
And that helps kind of bring prices down to a more reasonable kind of level in the 3 to 350 range. So that's what we're anticipating, is the Haynesville is going to grow. You also have associated gas with the Permian that's going to grow a lot too. Like I think we heard ConocoPhillips talk about today that they're a bit worried about Permian supply growth again, and it's sort of this funny situation we're in, where I think last year everyone said, supply growth in the U.S. is over and they're never going to grow again. But certainly that's not the case. We're expecting almost 1 million barrels a day of growth out of the Permian, and 2 BCF a day growth out of the gas side of the Permian.
Yeah.
So the Permian's a big gas play.
Yeah. The EIA just put out Permian oil output forecast to hit record high in February.
It's there for sure already.
And so when you take a look at the Haynesville down in the Louisiana area, down near the Gulf Coast, is a wonderful place for like Cheniere. Mm-hmm. And after they got their Train 6 on, so that they can start putting out that LNG to Europe, there's some profit. I mean, that was also kind of goofy. Just recently, they had all of the LNG ships being, one was in Hawaii. Can you believe that, Dane? And it got turned around and went to Europe. It's what, $300,000 just to go through the Panama Canal? Holy smokes, that's a lot of extra money they're willing to pay just to get a load of LNG.
Interesting. Yeah. I mean, 300 grand is probably a drop in the bucket with these vessels, but yeah, that's
my credit card goes that high. I don't know. Yeah. But we sit here and we think about the Haynesville. The Haynesville is the gift that keeps on giving. And and when you take a look at the Marcellus up there, it just is a shame that the Marcellus is such a gas-rich field, and they can't have the takeaway going to the U.S. markets. That just is mind-boggling to me.
Yeah, no doubt. I mean, if you look at the Northeast, Marcellus and Utica, the takeaway is probably, if not the most important part of the sort of economic decision for an operator standpoint, right? I mean, the F&D is pretty cheap, right? Like your drill cost per molecule added is not very expensive, but it costs you, in some cases $1, if not more, to get it to market.
Right.
$1 in MCFE. So it's a different play for sure from that perspective. And so these big companies in Appalachia that have grown dramatically, been the drivers of the practically 0 to 35 BCF a day play that it is today, are sitting on great assets, and they're generating a lot of cash flow. But if there was a high gas prices or a reason to continue to grow, it's the calculus is a little different there than it is in the Haynesville, because if you add a bunch of production, the differentials that you'll receive on the rest of the gas that you produce is going to be, the pricing you'll receive is going to be rather low, just because differentials will widen significantly. And we think that'll probably happen a little bit in 2022. And even we think it'll probably happen in the Haynesville on a short-term basis. Okay. Because you need to see the Gulf Run pipeline come online at the very end of this year. Yep. And we think the Haynesville will sort of outpace capacity at some point this year. So there's always sort of these bottlenecks that tend to happen when the industry moves back to a growth mode. And certainly we do think that there's certain parts of the industry that are growthy again. I would say the private operators, the super majors are definitely adding growth in North America to offset declines elsewhere. And the publics are a bit still pretty conservative from a growth standpoint. They're not really growing in the same manner that these privates and super majors are in the US.
When we take a look at the I was reading a couple weeks ago about $1 billion natural gas plant going up into the Pennsylvania area. Do you remember which one that is, or what that it is going
I
on?
don't. I don't recall. Yeah,
yeah.
Unfortunately I don't. But I was having a conversation with a colleague the other day asking about, what if they just built a bunch of, a bunch of gas plants in the Northeast and ship power instead of shipping gas. But
Yeah.
I know that I'm sure many people have run that math, and there's probably good reason why there's not a ton of new ads.
Oh, that's funny. I'll tell you, we need to definitely get off of coal, and we do need natural gas. So I think natural gas is definitely the lowest way to help the emissions out there. We got a few more minutes here, and when you take a look at Enverus's, give us your last thoughts on what you think Enverus is going to come out, because you were part of 4 purchases from. I mean, you had a trail to get to Enverus. Where do you think Enverus is going? And tell us what's on the next hurdle or next corner for Enverus.
Yeah, for sure. I mean, it's a big company today. I think the last time we had a new private equity sponsor in 2021 that injected capital at around $4 billion valuation.
Wow.
So it's a big business today, and there is there's a fantastic team that's been assembled. From external hires, tons of internal people that have either come from different parts of the sort, Enverus family, kind of looking backward. And so, the whole organization, I think, is rallying around the necessity and the importance of energy for all our livelihoods. And I think last year in particular, given the run up in commodity prices, given the run up in just pricing, like inflation, I think it's a lot more apparent. You had a European energy crisis that luckily that, a warmer winter didn't have as many negative consequences as it could have.
Right.
But overall, I think there's a more kind of societal push to bring energy sort of the forefront of conversations. And so everybody here is sort of an energy nerd, if you will, right? Like they're super fascinated by the industry, and they want to do their part to make our clients' lives, which most of the time are either, look to do financing in the energy industry or look to operate and develop projects, whether it's on the upstream, midstream, downstream sides of the supply chain. So we can do a lot as a technology provider to help to make their lives easier, to help make their decisions armed with more data, and so they can make more accurate decisions about what different whether it's a supply and demand forecast, whether it's optimizing a given unit of drilling spacing unit in the Permian Basin. There's many different ways we can help, but certainly that's sort of our North Star. And we're continuing to sort of invest in our products. So ultimately, all our clients can do their jobs better and deliver, a reasonable cost energy mix to the global population.
I'll tell you what, Dane, that is a very good way to say everything there. And it's, if you got to make decision in the energy space, you better make it based off of data. And if you need data, go to Enverus, because I'm impressed with all the data resources and the products. Holy smokes.
Oh yeah, me too, for sure. It's great. Yeah.
Anyway, well, thank you very much for stopping by the podcast, and look forward to getting this out, and we'll have your contact information in there as well too. So thank you very much.
Thanks, Stu. Appreciate the time today.
All right. Bye.
Bye.